Over the course of the next couple of minutes, I'm going to talk you through how bonds are taxed for individuals. The primary focus is going to be around when a chargeable event can occur, how a chargeable event gain can be calculated, and finishing off very briefly with how tax would be payable on that gain in accordance with the individual's own income tax position. It's important to note that with UK bonds, so onshore bonds, basic rate tax is deemed to be deducted within the fund. So in other words, the bond carries a 20% tax credit. With an offshore bond, however, no tax is deemed to be deducted. With regards to investment bonds, the bonds are usually written on the life of an individual person or multiple people. This means that, for example, where the bond is written on the life of just one person, when that sole life assured dies, at the point of their death, that will trigger a chargeable event. If the policy is written on a multiple life basis, then usually the last life assured to die will trigger a chargeable event. It is also possible for the bond to be written, for example, on a joint life first death basis, and in this scenario, death of the relevant life assured will trigger the chargeable event. If the individual surrenders the policy, and that means they fully encash the policy or the policy matures, that too will trigger a chargeable event for income tax purposes. With regard to investment bonds, these are written on what's known as a clustered or segmented policy basis. What that essentially means is that each policy is almost broken down into mini sub-policies. So, for example, somebody could have invested £100,000 and that policy could be clustered or segmented into 20 segments. In a situation where they decide to surrender one, two or any number of those segments or clusters, at that point, again, on encashment, a chargeable event will arise. And it's important to note that in these scenarios, the event takes place at the time those encashments are made. With regards to investment bonds, it's also important to note that under current legislation, it's possible for an individual to take up to 5% of the investment amount. So again, let's say somebody had invested £100,000 within the policy. They could take up to £5,000 each year on an annual basis. If in the event that they were to take any more than the 5% allowance, and it's very important to note that that allowance is cumulative, but if they did take more than the 5% tax deferred allowance or the cumulative allowance, that would also trigger a chargeable event. In these circumstances, where an excess withdrawal, that's what we call it because they're taking more than the allowable amount that they can withdraw from the policy, if an excess withdrawal is taken, the chargeable event will arise on the last day of the policy year. The simple formula to calculate the chargeable event gain is broadly based on the amount the policy pays out, so otherwise known as or referred to as the surrender value, plus the total amount of capital withdrawals that an individual's taken from the policy, less the amount that was invested in the policy, plus any previous chargeable excesses. The best way to describe this or explain this is by way of example using some numbers. So let's say, for example, Freddie took out an investment bond. He invested £200,000 into that policy. 7 years later, he's taken no withdrawals and he decides to surrender that policy. And that policy at that point is worth £240,000 for argument's sake. The simple calculation will be based on the amount the policy pays out, i.e. the value at the 7-year point, which is now £240,000, less the amount that he had invested in the policy, which was £200,000. So the chargeable event gain in that scenario would be £40,000. Let's move that on a stage then. Let's say in Freddie's example, he's taken 3 years worth of cumulative allowances So on a £200,000 investment, 5% per annum would be £10,000 each year. Let's say, for argument's sake, he's made a withdrawal of £30,000. Again, using the same numbers, he decides that he wishes to fully encash the policy in year 7 or year 8. The policy is now worth £240,000. Because Freddie had taken some capital withdrawals, you'd add those withdrawals to the amount paid out, as I explained in the earlier computation. So 240 plus the 30,000 would be 270,000, less the amount that he invested, which was 200,000, giving rise to a chargeable event gain of 70,000. It's very important to note that had Freddie taken a chargeable excess, so again, for argument's sake, let's say he had taken an excess of £10,000. That excess would normally be taxable, as I explained earlier, at the end of the policy year in which that excess occurred. And because of that, a bit of credit is almost given when you do your final tax computation. So in this example, again, we'll use exactly the same figures, just amending the withdrawal amount of 30,000 as being 40,000 that he took in year 3. So again, the amount the policy paid out was 240, plus total capital withdrawals would be 40,000, so you'd include the excess in this bit of the calculation. So that would be 280,000. Then you would deduct from that the amount he'd invested and the previous chargeable excess of 10,000. The amount he invested was 200, the previous chargeable excess was 10,000, so that deducted from 210,000 deducted from 280 would also give rise to a chargeable event gain of 70,000. Broadly, when a gain is added to an individual's other income, on the basis that the individual is not pushed into a higher rate tax band, so let's say that the gain added to the other income, they remain a basic rate taxpayer or a higher rate taxpayer or an additional rate taxpayer, they would be taxable on that chargeable event gain in accordance with their rates of income tax, bearing in mind, of course, that you would have the basic rate tax credit for onshore bonds of 20%. However, in a situation where you add the gain to the client's other income and it does push them into a higher rate taxpayer, so in other words, a basic rate taxpayer becomes a higher rate taxpayer as a result of generating the chargeable event gain, or a higher rate taxpayer becomes an additional rate taxpayer as a result of generating the chargeable event gain. In these situations, there is some relief available, which is otherwise known as top slicing relief. Normally, the individual would be taxed on the gain, on the whole gain. However, with top slicing relief, the method used here is that you would divide the gain by the number of complete relevant years that the policy has been in force to determine how much extra tax may or may not be payable. So essentially, an individual has a chargeable event gain, let's say, of £100,000. The policy's been in force for 10 years. The top slice gain in that situation would be £10,000, and it would be that £10,000 that you would add to the client's other income to determine whether any part of that falls into the higher rate tax bracket. And it's very important to bear in mind that in calculating the tax payable, you would then need to not only tax the extra portion at the 40% rate, but you'd multiply back up by the number of complete years, so 10 in the example I've used, that the policy's been in force. Now, with regards to bond taxation, obviously this has given you a broad overview, but the rules can differ, especially in situations where, for example, the policyholder has been non-resident for any period of time, or where they encash the policy quite quickly or soon afterwards, having incurred a large chargeable excess, or if, for example, the policy had been assigned for consideration, etc. So there are some intricate rules that apply to bond taxation, but we have got a lot of information under the UK Life Policy Taxation chapter in TechLink.